One of the things I've learned on this channel is a lot of you folks are just like me. You're out there trying to do it yourself, retirement, preparing for retirement, just into retirement, and you're constantly looking for new ideas, new ways of doing things. Is there a better mousetrap that somebody else has found? Am I doing things the right way? Am I avoiding pitfalls? That's me. And hopefully you enjoy some of this content. Please hit like and subscribe. I don't say this in every video. Hit like, hit subscribe. Let the YouTube algorithm help me push this out to more people. Actually make a little bit more money when you do that, folks. So gives me encouragement to keep making these videos. So, hey, today, under the heading of continuous learning, I want to share some of the things I've been working on in the last few weeks. One, I continue to look at my buckets to make sure that that is going the way I want. I have 3 buckets as a reminder. Well, to back up just a little bit more, I'm 58 now. I've been retired almost 4 years, and it's been great. It's great. It's better than advertised. But I have a target of 0, my first 4 years expenses in bucket 1. Really in out-of-the-market things, like CDs and cash and savings accounts, I-bonds, things like that that are out of the market. And then my target is to have another 4 years in conservative investments like dividend-paying stocks and some bonds. So that's another 4 years. And then I have money that I need starting in year 9, all in equities. Okay, those are my 3 buckets. Okay. And the intent is with bucket 1 that it's sized at 4 years so it can handle a bear market, a recession like we're in right now. So I currently only have about 3 years in that because we've been on this slow decline. So I'm taking no action most of the time. Okay, I've got a lot of other videos on buckets. Buckets is what I do, okay? But I'm going to look at Fisher Investments. I had a 90-minute conversation with an advisor there. And then I'm going to look at something called Retireable.com, a different approach that I haven't seen before, and just to give you my evaluation of those 2. Okay? Fisher Investments. I had a conversation with a very nice gentleman walking me through the details of Fisher Investments. It was probably an hour-and-a-half conversation. Very knowledgeable individual. I did like a lot of things about their setup. And there's a few things I didn't like. So pros and cons right here and my decision with Fisher Investments at this point in time. I'm not going to cover every detail of Fisher Investments, but kind of my top 3 pros and cons. Number 1 pro is they don't have expense ratios and no hidden transaction fees, which are in every mutual fund that you buy. Even exchange traded funds have some hidden fees in them that's not reported to you beyond the expense ratio. Fundamentally, they're set up. They have 5 people in Fisher that buy all the stocks. What they do is they go into the 11 market sectors, healthcare, energy, materials, industrials, financials, all those sectors. They pick the 5 to 10 best companies that they like. They like the way they're managing their finances, their debt, their prospects in the market, their management team. They like them. And they have an education focus. So I like that about Fisher. I've said this before, yes, the last 10 years, exchange-traded funds, very low expense ratios have done very well, exceedingly well. I believe that going forward, some managed funds, looking at the fundamentals of a company, makes sense for the next 10 years. We'll see how that works out. I know I disagree with a lot of folks on YouTube with that. I do have managed funds, but I like the way, I fundamentally like how they're set up. Now, the cons with Fisher, they do try to time the market. When the market goes bad, they can move everything to cash and then move everything back. Timing those 2 transactions, when to stop, when to get back in, can be very difficult. That just doesn't sit well with me. They may be great at it, okay, but it doesn't sit well with me. Number two, and this is the biggest one for me, is high fees. On your first million you have with them, you're paying 1.25% in fees. Yeah, you're not paying expense ratios, but it's high. And then it goes to 1 point, it just goes higher or a little bit lower for your, 1 to 5 million, a little bit lower for if you have over 5 million. But, if you're using a mutual fund that is, say it's an exchange traded fund with, 0.03% expense ratio, and then you're paying an assets under management of 1%, you're paying 1.03, which is, definitely lower than this, but it's in the ballpark. They both begin with 1, right? It's in the ballpark. But that's very expensive. In all markets, you're paying 1.25. Also, very high pressure solicitation. Their model is that I'm going to guess a little bit here. They have a group of people that just make cold calls based on where you live, how expensive your house is. They're targeting people that have over $500,000, and they really wear you out. Like a timeshare kind of experience to sign up to have this 90-minute call with an advisor or counselor, as they call them. Now, the discussion with my counselor was great. Wasn't high pressure, very good exposure of how they're modeled and their fees and their philosophy, and didn't high pressure sales me at all. But to get to that meeting was, it wasn't a good experience at all. It turned me off, quite frankly. So all things considered, and I make things simple, okay? And hopefully you appreciate that about my channel, is bottom line, the high fees make this a no-go for me. I don't see how they justify 1.25%. Their overhead looks pretty low. They got 5 people picking all their stocks. I'm sure they got teams and they do research out there, but it sure seems like this could be 0.5. And if their fees were 0.5 and they're going out and picking the top 5, 10 companies in each sector that they like, and you've got an advisor and you're doing some education, I actually think this would be a pretty good option, but it's at least 2x the fee that I think is reasonable. So Fisher Investments currently, I think, is a good idea. They got a good foundation. They got good concepts. They got a proven track record. Fees are just twice what they should be. Okay, one of you folks out there sent me a website called Retireable.com and asked for my evaluation of it. And so, hey, I like to look at these things. So let's take a look at this. And I didn't spend near as much time on this as I did with Buckets or with Fisher Investments and some of the other things I've looked at. But Retireable, this was new and unique to me. But taking a look at them, one, they send you a monthly paycheck and give you a credit card. So, you invest your money with them, and, you say you need $3,000 a month. They send you $3,000 a month. Or you can have it on your credit card. You just charge everything on your credit card, and then they take it out of your account. And their asset under management fee is only 0.5%. That's quite a bit lower than market. Market people typically place it about 1%. So those are a couple pros with these guys. Hey, it makes it simple. It's kind of like a pension, kind of like you're still working. You just got this money coming in, and then you just don't have to stress about which fund you should take money out of. Should I take it out of my Roth? Should I take it out of my IRA? Should I take it out of my savings? Wherever. They just send you a paycheck, and it's like you just keep on working. Those are the pros of this Retireable. I think that's unique. Maybe a lot of companies are doing this. This is the first time I've ever heard of it, that they just send you a payment that you agree to. The cons for this is, I don't know the quality of their advisors. And what am I paying for? Am I paying for budgeting? You know, if they're, do they have a bunch of people just, you know, saying, you know, issuing these checks and managing the money going around and which funds it's coming out of versus, and simplicity, you know, it's simplicity for my life. I got this check just coming in. Or am I paying for financial advice and stock picking or best mutual fund to be in? What am I exactly paying for? It seems like, you know, 0.2 per, 0.2% maybe just in administrative things to do this. And then you're only paying that 0.3% advisor, which makes me question the quality of the advisors, the quality of the advice coming in, because that is so much lower than an advisor that was working on their own, working for the Capital Group, working for, you know, even Vanguard. So I'm not sure if you're getting top tier advisors with this group. Those are just my, you know, I've probably studied this for 30 minutes. Okay. So that's just my evaluation. You know, for me, this is a no-go. You know, that to me, even though that's a great fee for having an advisor, I still don't like that. And I don't know about the quality of advice. I don't need this oversimplification. And I certainly don't want to be paying for that. As you probably already figured out, at this point in time in my retirement, I still conclude that buckets is the best approach towards having an epic retirement. Yes, it does not maximize your return. You have a lot of money for up to 4 years sitting in non-producing assets. It's getting a little better now with rates going up. But remember what you're trying to do in retirement. You're not trying to maximize returns. You're trying to have peace of mind and have that epic retirement. So I still like buckets, but I'm telling you, I'm still continuing to search. I'm still continuing to analyze, and I want to continue to keep you folks informed of my journey so that it can help you have that epic retirement, to have you retire early. If you got topics for me to research, send them to me in the comments. I'll give you an opinion. Good chance I'll make a video of it. This is Joe out.